Hey everyone, back with another daily update video, and I wanted to do something a little bit differently today and do a little bit of a story time. I found a transcript online about somebody posting why they think that we are in a bubble and why the economy is going to crash. So I just wanted to talk to you a little bit about that and see if you agree or disagree with this, but I tend to agree with most of this right now. So it seems like right now the stock market is going to continue to rise as long as the Fed continues its printing of money or its monetary policy. And a lot of people suggest that this is representing a bubble. And I think correctly, they pointed this out because the Fed is intervening in the economy in such a big way in the stock market that the value of these asset prices is becoming very disconnected from the fundamentals of the underlying or real economy. And so there's a gap between the real economy and the stock market. And this gap is being caused by the Federal Reserve, which would typically mean that we're in a bubble. And stock prices are most likely going to collapse if you're in a bubble, right? The other possibility is that if the bubble doesn't pop, that maybe the bubble will just deflate very slowly, which would be the best case scenario. And even Warren Buffett famously said that bubbles could take years to pop. So if we are in a bubble, if you're expecting a big crash or downturn, it may not even happen this year. It could be drawn out over multiple years. If you look back in time, there was the housing bubble that kept growing and growing from 2003 to 2007, so over 4 years. And the tech bubble also took years to kind of grow and grow and grow before it popped. So it doesn't necessarily have to pop in a very spectacular fashion. It could, like I said, just gradually deflate over time until it goes away completely, which if it just does a slow bleed, that's not going to cause a lot of harm to asset holders. But just because the Fed is intervening in the markets and propping up stock prices does not mean necessarily that stock prices are going to collapse in the very near future. So what are two things that could cause this supposed bubble that we're in to pop? Well, they're working, and you can see this right now in interest rate policy. So the way this system is supposed to work is that the Fed has a lever essentially, so they can either raise or lower interest rates. If the economy gets too hot and they want to slow things down and inflation starts to pick up, the Fed will raise the interest rates to make it more expensive for credit to get into the system. And then, boom, things should start to cool off. If you're in a recession, however, you need to stimulate the economy. So you do the opposite. You lower the lever, in effect lowering interest rates, so people have greater access to credit, and that would stimulate the economy. The problem right now is that the lever is broken and doesn't work anymore. And why is that? Well, it's because back in 2008 and 2009 during the Great Recession, we already lowered the lever down to zero. So at a time where we need to lower the level, there's no much lower it can go unless you start talking about negative interest rates, which Chairman Jerome Powell has already said he's not willing to do negative interest rates. I think in the future, if he ever changes his mind and does decide to impose negative interest rates, I think the stock market will react very violently and cause a very big drawdown, but that's just my opinion. So if another recession comes along, and actually we are nearing the end of the second quarter of this year, the first quarter we already have negative GDP. And it's likely that this second quarter's GDP is also going to be negative. So in theory, we are already in a recession. But if we finally confirm that we're in a recession and you can't lower the level any further, unlike the European Union actually has done this with negative interest rates, if you want to go see how it's worked out for them. But if you do negative interest rates and you can see the EU, it comes with its own slew of problems. But like I said, Jerome Powell has already said that he's not going to do that in the United States. So the lever is broken right now, and we're going to leave it broken because it can't get any lower than zero. So then what is the Federal Reserve supposed to do after that? Well, since you can no longer manipulate the interest rates, the other option the Federal Reserve has is what they're calling quantitative easing, or QE. But the problem is that's also broken, and it's broken for a few reasons. One of the reasons is we are running out of bonds to buy, and we're running out of stuff that the Federal Reserve can go and buy, right? So the problem with quantitative easing was that it was never supposed to be this big, meaning it was never supposed to go beyond United States treasuries. And the reason is because it's actually illegal for the Federal Reserve to purchase anything other than government issued debt, which is why they have to set up these special purpose vehicles through BlackRock and such to go out and buy other debt instruments. So what other things is the Fed going to buy? Well, in 2008 and 2009, they expanded it just beyond government debt and started buying back mortgage-backed securities and asset-backed securities. So they're buying the entire investment-grade corporate bond market. They're buying pieces of the junk bond corporate market, and they're buying junk bond ETFs. So now what else are you going to buy as a part of this new quantitative easing program? Well, the Fed could buy stocks, they could buy ETFs, which would be the single most crazy thing in terms of monetary policy that you could do. In the entire lifetime of the Federal Reserve, I don't think that that's going to happen, because if it did, that would just be absolute insanity. And if quantitative easing no longer works because there's nothing else for the Federal Reserve to buy, what else does the Fed have in order to stimulate the real economy? It doesn't really have much. So let's just say you get laid off from your job and you no longer are working for a living. The Federal Reserve buying corporate bonds isn't going to help you that much, right? You need personal income, you need a salary, you need a paycheck. The Federal Reserve buying up bonds is not going to help you. So it turns out that by both lowering interest rates and doing quantitative easing doesn't do a whole lot right now to stimulate the economy. And in terms of the wealth inequality gap, this is only going to make it worse. So the only people that really benefit right now from the Fed's actions are the people that hold assets, right? So if you own stocks and if you own bonds, you're doing pretty well right now, right? We had the run down in February, March, and then we had the run back up. Some stocks are even higher than they were pre-pandemic, and they're at all-time highs. So you're doing pretty good. However, the problem is that the vast majority of people don't own stocks and they don't own bonds. So they're not benefiting from this policy. If you didn't have any skin in the stock market, it didn't matter to you when the market crashed or now that the market's running back up. You were still back to where you were in terms of, your situation. So those people are not benefiting at all from quantitative easing. And then the other thing people like to talk about is how we're in a period where stock prices are so disconnected from the fundamentals, but this is no different than what we've been doing for the past 11 years. It's only been made worse by the pandemic because the underlying economy is so bad. But in a world right now where we have 0% interest rates and unlimited quantitative easing, can you really have the slowest economic recovery since World War II while also having an 11-year-long bull market where the S&P has increased up to 400%? Nobody was really talking about the gap at that point, but we're talking about it now that the pandemic has happened. So what this has forced the policymakers to do is basically experiment with new ways to try and stimulate the economy. So first you saw this with combining monetary policy and fiscal policy. So you see Jerome Powell coordinating with Steve Mnuchin in terms of combining the monetary policy and the fiscal policy. So one thing that the government did is they wrote people a check for $1,200 and put it in their bank account. And right now, that does more for the real economy than the Fed buying corporate bonds. So going back to that similar scenario where if you were unemployed now, you have no paycheck, you have no income, the Fed buying bonds is not doing anything for you and your family and your livelihood. But if the government puts $1,200 in your bank account, well, now all of a sudden you can buy food and groceries and gas for your car and things like that. and you're going to go and spend that money and stimulate the economy. So you can see there is some benefit of coordination between Jerome Powell and Steve Mnuchin. So that's the first thing. The second thing you're going to see is what's called yield curve control. And so what that means is that the yield curve control has already been implemented in Japan since 2016, and Australia has recently started doing this. And that means that the Bank of England and the United States Federal Reserve is probably not far off now. They're probably going to follow suit. So yield curve control is basically a policy, and it's very similar to quantitative easing in that it determines what we're going to buy and in what quantity of a certain bond, for example. So we're going to do $50 billion in mortgage-backed securities, or $100 billion in corporate securities, or whatever you have to do in order to have yield curve control. So it doesn't specify a certain quantity of bonds that you're going to buy, but in turn it specifies a target of a specific yield and then buys however many bonds it needs in order to achieve that yield. So essentially you set a goal and then you buy whatever you need to achieve that goal, as opposed to just buying a fixed number of product and then letting the end result be whatever it's going to be. So you're kind of setting a benchmark and then doing what you need to do to achieve that benchmark. So they could say, for example, that in the 5-year part of the curve, we're going to target a 50 basis point yield. So if it's currently at 60 basis points, for example, they're going to buy as much as they need in order to push that yield down 10 basis points to 50. So that's just an example scenario. So I think that the Federal Reserve is probably going to implement something similar by the end of this year. And there's a lot of other economists in this country that think the same thing. And you can see this if you actually look at the yield curve right now. You can see that a certain part of the curve between the 1-year and the 10-year mark has been artificially pushed lower right now because traders are pricing that in that we're going to see yield curve control. And if it comes true, it's going to be in that part of the curve. So now what effect would this have on the bond market and on the equity market? Well, unfortunately, it's going to raise it even more. This is going to inflate the bubble even more because people are going to continue to chase this yield. And if you push down the yield at the short end of the curve, people are going to get pushed into the longer end of the curve, right? And that's more risky. So people now in the long end of the curve are going to go and get into corporate bonds. And people in the corporate bond market are going to get into the high yield market. And then from the high yield market, they're going to move to the stock market. And from the stock market, they're going to move into the private equity market. So everything is going to get inflated. Now, obviously it depends on which part of the curve they target and what they set as a target yield, but the overall scenario should not change very much if my hypothesis holds true. And in general, again, this is going to inflate asset prices even higher. So in conclusion, we're basically in an economic environment right now where the Federal Reserve is coordinating with the federal government and doing everything they possibly can to prop up or overly exaggerate asset prices. And that's only going to make the gap between the real economy and the stock market even further, which basically means that they're just going to keep pumping this bubble as big as they can get it. So let's say that happens. And the next question is, well, how is this bubble going to burst? Well, the one scenario is that it doesn't burst at all. So you have the real economy and you also have asset prices, and then you have the Fed in the middle. So if the underlying economy, if the real economy picks up and production grows, that's one way that we can close the gap between the real economy and the stock market. So if they can close that gap, the Fed could then get away or step away from the middle, and now there's no more bubble, nothing is bursted. And then the stock market won't go down, the credit market won't go down. This is the absolute best case scenario, and that's what everyone would hope for. However, if this doesn't happen, there's going to be two things that pop this bubble first. And what's really going to happen is probably slow productivity growth, meaning the economy, the real economy is going to grow, but it's probably going to be very slow. And so if it doesn't pick up, if the economy doesn't pick up and close that gap, eventually the Fed is going to have to at some point walk away anyway from the middle. And that means that if there's no longer the Fed buffer between the real economy and the stock market, that means the asset prices or the stock market is going to correct, and it's going to correct down. And this is what happened back in the end of 2018 from September to December, because the stock market at that time dropped 20%. So again, we're in an environment where the stock market at that time was on a 9-year-long bull run. However, if you looked at the overall economy, the real economy, it was the slowest economic recovery since World War II. And the other issue is you can't keep interest rates at zero forever. You can't do quantitative easing forever, despite what Jerome Powell says. So if it doesn't make any sense, this is what got us into the problem to begin with, because like I said, the lever is broken, quantitative easing is broken, and so you've used it too much, right? They've done too much quantitative easing. They've already lowered interest rates too much. So once you do it so much, it no longer has any effect. These tools that the Fed had were not meant to be used forever. They were meant to be used and brought out only for short periods of time when you have a real problem, and then put back away for the next time an issue arises. But the issue is that the Fed has been doing these in terms of the interest rate control or lowering of the interest rates for a long time now. And they're also considering now doing quantitative easing for a long time now. So they're just slowly making this bubble bigger and bigger. So unless, like I stated earlier, if the economy's production, if the real economy productivity does not increase, we are going to have this bubble pop at some point, in my opinion. Because at some point, whether they like it or not, the Fed is going to have to walk away from the middle. And that's what's going to cause the asset prices or the stock market to get back in line with the real economy, which is not looking good right now, right? Coronavirus cases are increasing right now. People are not going out to restaurants, they're not eating out. Disney has just announced that they are going to delay opening their theme parks, so people are not going to go have fun at Disney World. So the economy is still very, very slow. You know, states right now are ramping up maybe lockdowns again or quarantine periods. So the target right now by some economists is 2023 in terms of raising interest rates. So if in the next 3 years or 2.5 years now, the real economy has not recovered that much, you're going to start seeing a drop in the stock market or a drop in the asset prices. So that's the first issue. The second issue now is going to be inflation. Because if we have really bad inflation, that's also going to be very bad for the overall economy. So it's hard to imagine where you have this massive demand shock where everybody's cooped up in their houses. They want to go out, they want to spend their money, they want to go to sports games, they want to go to restaurants, they want to go to the movie theater, but nobody is spending any money. And that could cause inflation to rise also because of all this quantitative easing. So we've had historically long periods of low inflation, and the Fed has had a target of a roughly 2% inflation rate per year, but they have not been able to meet that target recently. So it's very hard to believe, but inflation is going to come, and people are not going to be thinking about it, because if inflation starts to pick up, it's going to be disastrous for the stock market. And you're already seeing certain areas where inflation might go up, right? So if you look at oil prices right now, they've rallied spectacularly, right? There was a point not too long ago where oil prices were zero and then actually negative, but they've rallied very hard just in the past few weeks and months. This was due to the price war between Saudi Arabia and Russia, which has pretty much been squashed right now. And obviously oil prices are a big component of inflation, not just because of oil, but because of all the thing oil is used in. For example, oil is used in cars and trucks, right? So when you buy products that get shipped cross country from different warehouses to the supermarket to the store, that's all using transportation vehicles that rely on oil. So if the price of oil goes up, that means the cost of shipping products around the country and things like that also go up, which means that the company is going to have to pass on those added costs to the consumer, to you, meaning the price of those products is also going to go up, right? So that's one way in terms of inflation and using oil prices as an example, how that could hurt the economy. Another example is that people and companies are going to have to move out of China or reduce exposure to China because of the pandemic. So they're going to have to take that money or spend money and now look for supply chains elsewhere. For example, if you look at the price of meat right now, the price of meat has gone astronomically high because the amount of extra money now that companies have had to invest in terms of making sure they're not spreading the virus has been passed on to the consumers. So their operating costs have gone up. So now they have to charge more money for that meat in order to cover their costs. So the other thing that we want to look at is that we've been throwing so much money into the system in terms of quantitative easing and the stimulus checks that the actual money supply has gone up, right? And it's gone up significantly since March. So when you have just a lot more money in the system, well, naturally inflation is going to follow that big pump of money. So the system has basically, held these asset prices high throughout the crisis, right? When you go to the grocery store or supermarket today or tomorrow or next week, take a look at the prices of goods and see if they've been the same, if they've gone down or gone up. Chances are they've probably gone up, right? So the big concern here is that if the economy, the real economy, does not start and pick back up and increase production, we're going to have all this money in the system. You're going to have rising oil prices. You're going to have extra costs in terms of companies having to redo their supply chains. The price of goods is going to go up, and you're going to be in this spiral of absolute disaster, because the only way to fight inflation is to raise interest rates. And to do that, you're going to pull money from the system. So inflation would effectively force the Federal Reserve out of the equation, like I said before. So the Federal Reserve is going to step away, and then now you have nobody in the middle between sky-high asset prices or the sky-high stock market and the real economy, and that's potentially what's going to cause this massive bubble that we're in to pop. So let me know what you think about these facts or these opinions. Let me know what your thought is. Do you think it's possible that instead of having a bubble pop, that we're going to be able to slowly deflate it over time and be okay? Do you think we're in a bubble at all? I'm very curious to hear your opinions and thoughts, so leave them below in the comments section below. If you like these types of videos, hit that like and subscribe button. And as always, happy trading.